The worst thing you can have is a situation where you're expecting to deliver credits at a certain period of time and you're not able to deliver those credits because of the need of needing to continue to extend the forward period because of the lack of being able to convert on time.
Welcome to Buzz House, a Baker Tilly podcast where you can find all the buzz around multifamily housing. I'm Don Bernards, the partner in charge of Baker Tilly's multifamily housing practice.
And I'm Garrett Gibson, a partner at Baker Tilly, also specializing in consulting on multifamily housing transactions across the country.
Each week, we'll bring you a guest or a topic in the multifamily housing industry that will help you win now and anticipate tomorrow. Let's get started. Our guests today on the Buzz House are Dan Smith, a senior vice president with U.S. Bank, and John Gilmore of Walker & Dunlop, a managing director. We're going to have a discussion on how things are looking in the debt markets. Before jumping into our discussion with Dan and John, just a couple of items around industry news. In early September, the White House announced a number of housing initiatives with a goal to increase the supply of affordable housing. One of the items is allowing Fannie and Freddie to increase their annual amount of tax credit equity investment into the low housing tax credit market, up to $850 million each, which is up from $500 million. So $700 million extra dollars on the equity side into the market. With their duty to serve mission, the Fannie and Freddie money has helped to reach into rural markets and other difficult projects. With the fixed 4% rate enacted at the end of 2020, we have seen the overall tax credit equity market increase by a couple of $1 billion. A second item which relates to debt, our topic today with our guests, is the reinstatement of the Federal Financing Bank, or FFB, initiative to support FHA and Housing Finance Agency multifamily risk-sharing program loans. There will be no dollar limit on the amount of financing FFB is authorized to provide. HFAs will have 3 years to enter into commitments for FFB financing. We'll definitely keep you in the loop on this as it kind of continues to roll out. Just a couple of announcements. The first announcement is that the Capital Magnet Fund, NOFA, came out. Garrick and I have talked several times about the Capital Magnet Funds. This NOFA came out in early September. And the CDFI fund will award $383 million in this round. So we know a number of people are working on their applications as we speak, due in a couple of months. Also of note is the first week of September, the CDFI fund announced the allocation of $5 billion of new market tax credits. So if you have a commercial or mixed use project, make sure to be in touch with a number of allocatees that have the $5 billion of new markets. And finally, with the budget resolution discussions ongoing in Washington, D.C., we'll have definitely Buzz House podcasts this fall to give updates and any other kind of related legislation around housing. Now we have a lot of topics we want to cover with our guests. So Garrick and I will jump into our discussion with Dan and John. Garrick?
Don, and thanks for that intro. We like our listeners to know a little bit about our guests. So why don't we go ahead and start off with you, Dan? Why don't you let our listeners know a little bit about your role with U.S. Bank?
Hey, thanks, Garrick. Thanks, Don. It's good to be with both of you today and with John. So my name's Dan Smith, and I head up business development. So basically loan acquisitions for U.S. Bank's affordable housing debt group. We're part of the U.S. Bank CDC, which does equity and debt across really all credit programs, but the team that I'm on works with the low-income housing tax credit. So the vast majority of what we do each year, which is about $1 billion, is construction loans on LIHTC deals. We work on deals where we do the equity. We work on deals where syndicators do equity. We work in all areas of the country, primarily in U.S. Bank's banking footprint, but we also do some stuff outside of our footprint. And we work with many different permanent lenders. And I've been with the bank about 9 years, since 2012. And it's good to be with you.
Thank you, Dan. So thank you for that introduction. And John, why don't you go ahead and let us know about what your role is at Walker Dunlop? Thanks,
Garrett. And Don, I definitely appreciate the opportunity to join the podcast, and also alongside a great industry colleague at U.S. Bank, which has been a partner to us on some transactions that we've worked out with their construction loan debt group. Primarily, I would say the shortest answer to that question, Garrett, would be my role is to really control everything outside of my control. jokes aside, I have the esteemed pleasure of originating capital market executions across the country focused on affordable housing, focused on the affordable housing industry. And that's primarily loan originations through Fannie, Freddie, and HUD. It is definitely a major topic of interest with Walker & Dunlop. Over the past 3 years, Walker & Dunlop on the debt side has originated over $17 billion debt financing transactions tied to affordable housing through our main capital providers being Fannie, Freddie, and HUD. We do this nationally, and we're looking to really grow and extend our platform across the country and expand our business to affordable housing developers. And really happy to be on the podcast today with everybody.
Well, thank you. Thank you for that introduction. And Dan, let's go ahead and jump in. I'll start with you, Dan. So on the construction loan side, over the last 18 months, we've had a pandemic going on and possible supply chain issues. You had risk of slower lease up, et cetera. Have you seen any underwriting changes or any different stress testing?
We certainly have. I think early in the pandemic, which seems like a long time ago, we were worried about a lot of stuff. I think there was a lot of uncertainty. No one knew exactly what was going to happen, how this was going to impact our industry, how it was going to impact the broader economy. I think in 2021, so really since the start of the new year, most of our concerns on the construction lending side are over development costs and time. I think early on, I'll talk a little bit about costs first. I think everybody probably, if you're listening to this podcast, you probably are involved in the LIHTC industry. So, everybody who was doing a deal earlier this year, I think, say before June 30th, probably learned what the lumber index was. That was the vehicle for all of our anxieties about construction costs, was that lumber index. Now, I had never paid attention to the lumber index before, but I sure as heck did between about March 1st and July 15th of this year. So I know it hit an all-time high of 1,670. I couldn't even tell you, Garrick, what that measures. I don't think it's $1,600 per foot or anything like that. And this was an index that's usually in a range from 500 to 700. Now, the last several months, it's been back down in that normal range. So, that indicates that on the material side, things have settled down a little bit. I think what hasn't settled down is the labor side. I think when we talk to our clients and when we look at our projects that we have going, there have been some delays. Early in the pandemic, I think we were worried about job sites being shut down, and we saw a little bit of that. But really, I think what we have now is just a lack of labor, which is impacting budgets. It's impacting time frames. Nothing too serious at this point. We're not looking at a catastrophe by any means, but it's probably something more that's, something to keep an eye on. One other thing I would note, this is probably something that the developers and general contractors who are listening can relate to, but we've seen a lot of approvals and paperwork from building inspectors and zoning inspectors get delayed. And it seems like there's probably a little more, this is a paperwork intensive industry that we work in. But I think with some of the government agencies still working from home, I think we've seen some delays and even a few curveballs come up on construction deals. On the leasing side, we've had some senior projects have been a little bit slow to lease. Nothing that we're really alarmed about. I think it's just, in some markets, seniors just aren't out looking for housing right now. So I think seniors are probably taking, the COVID precautions a little more seriously, maybe than the general population. And I think, they're probably a little more reluctant to move than they have been in the past. So we're seeing some slower lease ups on our senior projects. In the family space, I honestly don't think we've seen any impact on absorption. So those deals are doing just fine. So it's a rapidly changing environment. 6 months from now, we'll probably be worried about different stuff, but that's what we're worried about today, Garrick.
For that insight, Dan, yeah, I didn't really think about the slow lease up on the senior side. So given that, John, so I know you're not necessarily involved in the construction loan side, but given what Dan just mentioned, what are you seeing, or are you seeing any impacts on forward timelines due to the pandemic and any corresponding extension periods?
Yeah, that's a great question, Garrett, and I think Dan hit the nail on the head when he described some of the really the concerns and the mitigating factors that the industry is looking at as it comes to construction. I would say, although we don't do construction loans, like Dan mentioned, we also have taken a very, very close look at cost and plan and cost reviews and timelines. And like Dan, I didn't pay attention to lumber pricing until earlier this year. And by no means am I an expert on it, but it was at an all-time high. And I know it's come down, which is great. But still, I think it's definitely impacted our industry from a cost standpoint that you can actually see. Now, let's talk about the costs that you don't see that are kind of embedded in transactions that involve construction and forward commitments. Because of the impact of the pandemic and the fact that most of these transactions, we're talking about LIHTC deals, and primarily I'm speaking on the 4% side, and we'll talk about the 9% side a little bit later. But typically these transactions are done with forward rate locks that predict what the construction period would be and then a lease-up period. I would say in 2020 and in 2021 thus far, we have seen a large portion of those forward periods need extensions. Now, luckily, we are in the mission-based business, and there is a mechanism for always extending these forward periods. But I would give a drastic example of one particular transaction in which we are on our fourth or fifth extension period. That's a little bit of a unique transaction. I won't go into the details of that, but typically the documents only give you 1 or 2 6-month extension options to get from the construction period to the permanent conversion period. So the impact that it's had is now when you come in and want to request what would be normally a programmatic 24-month forward period, we're actually really taking a harder look at those deals and kind of, really making borrowers look at, a 30 to 36-month forward period to ensure that we give them enough time, because the worst thing you can have is a situation where you're expecting to deliver credits at a certain period of time and you're not able to deliver those credits because of the need of needing to continue to extend the forward period because of the lack of being able to convert on time. And the primary reason of converting on time really had to do with a lot of the items that Dan talked about earlier, which has led to slower construction periods, slower absorption periods, and thus needing more time to convert. And that all comes at a cost, because the way we enter into a forward rate lock, right, we judge the time period by which a property will convert. And then we also look at the duration and the useful life of the overall permanent loan period. And as that continues to get extended out, the investors that buy that paper and the market, they're going to want additional yield for the expected life of that security staying out longer than maybe what they expected the security to stay out pre-pandemic. And all of this is also coupled with a steeper yield curve. So although rates are low, the yield curve has steepened, which in turn has also added to the yield requirement for investors. So ultimately, it's definitely not only affecting the construction side, it's also affecting the permanent loan side as well, because we want to ensure, that we have enough time to deliver what we say we're going to deliver to the market, right? Which is we're going to deliver this piece of paper to a permanent loan investor at conversion, and then also from a tax credit investor side, they want to obviously deliver the credits when they expect to deliver the credits as well.
you for that. It's such a good illustration of that domino effect, right? So I do have a really quick question before Don wanted to ask a couple of questions as well. So this is a question for both of you. So during the pandemic, what have you seen in terms of operations and have there been many requests for forbearances? We're always interested in trying to find out if there are a lot of requests for these. Why don't you go ahead and start off with that, Dan?
So I know this was something we spent probably in March and April of 2020. We spent a lot of time gearing up for a wave of requests, both on our perm loan portfolio. We have some perm loans on our books, and then also as equity investor, we were expecting people to hit their operating reserves. We were expecting loan forbearances. You may remember the world kind of felt like it was coming to an end back then. And we really haven't seen that. I think I can count on one finger, maybe two fingers, the number of deals that have actually needed to take those measures. I think, the story is one of, I think the government stimulus, the pandemic, COVID relief bills, the extended unemployment benefits, really have helped tenants pay their rent over the last 18 months. So we really haven't seen much of that. I think, we've seen some properties with higher expenses, as you might expect. You think all of the mitigation factors that property managers had to take last year, that we've seen some of that. But on the income side, things have been pretty stable. I think, collections are off in most parts of our portfolio by just a few percent. It's certainly enough to be covered by our debt coverage underwriting. So that's good news. There's a few areas of concern. Government subsidies are coming in slower. I think, the one thing to watch, I think there's several things to watch over the next 12 months. I know I'm kind of expounding beyond your question here, Garrett, but, the rent relief that was in the COVID bill, I think that money's been very slow in getting out. That is true if you talk to LIHTC owners, I think they would all agree with that. And then, what's going to happen as the economy tries to wean itself off of stimulus? Are there going to be enough jobs for people to keep paying their rent? But the last 18 months have actually been pretty good. Much better than I feared 18 months ago, that's for sure.
John, did you have any comments on that, or?
Yeah, I would say, I really would agree a lot with what Dan just said. We at Walker & Dunlop, we service over 7,600 loans and almost 2 million units nationwide, with a large portion of that being in California, which was, kind of made obviously headlines the way they handled some of their policies as it pertained to renters. But we didn't see a whole lot of forbearance requests. I would agree that ultimately, tenants did find a way to pay their rent. And I think that in a lot of cases, maybe the rent didn't come in on time. So we kind of saw a lot of fluctuating collections, but ultimately we saw the rent getting collected. I think from an operation standpoint, I would agree that expenses, the OpEx side, has taken more of a hit as, a lot of, tenants were working from home, which, is obviously going to have more wear and tear on the on the apartments themselves. So you expect to see, higher maintenance costs, higher utility costs from, just the usage and items of that nature. One thing we have paid closer attention to when we look at a new transaction is not only the collections, but also we pay very close attention to delinquency reports. And I think that we really take a blank approach to how we analyze, whether or not rent is collectible. And that's something that we typically had not done pre-pandemic. So we really pay close attention to 30, 60, and 90-day past due. But we also take into account various stimulus programs that are out there in which tenants may qualify for. Because obviously the goal is to not have any type of tenant displacement, but also ensure that the rent is collected and that the owners of these properties can continue to provide and maintain quality affordable housing.
Very good. John and Dan, thanks for those really good insight. Kind of another question for both of you, and I can maybe start with John this time and Dan second. Our listeners are always interested in, about what rates have done and, where are rates today versus 18 months ago or things maybe, did some of the risk kind of factor into, I think you talked about some of the timing, John, and so forth, or maybe if you could just both touch, briefly on what's happened to rates and where we are, maybe really big ballpark today, John.
Mm-hmm. So I'll talk about rates in the permanent loan market. I think, maybe Dan can talk more about how rates in the construction lending market or the bridge lending market has been impacted. But overall, rates are very, very attractive. We definitely, when we first got into the pandemic, there was a little bit of a scare as far as liquidity in the market. I think the major index that we all judge everything by, which is the 10-year, it dropped to maybe somewhere around 40 basis points at some point in time. I could have my numbers off, but it was drastically low. And you also saw investor spreads widen out at that given point in time. And I think, as a country, I think there was a very, good response because we kind of had the blueprint from the 2008, 2009 crisis on how to react to a potential lack of liquidity in the market. And I think the Fed did a great job to ensure confidence in the capital market system, which, then kind of started to normalize the index a little bit and also push investor spreads down to all-time lows. I would still say, even though we're kind of in a somewhat of a rising interest rate environment, that if you want to call it that, it's clear the index is higher today than it was 12 months ago. But as we speak today, the 10-year index is hovering around 150 basis points, which is still, super attractive relative to, where cap rates are. So I still think it's a great time to be in the market to finance your properties. And I think rates can be utilized in a manner to really help to drive returns, because the fact that rates have come down as much as they have on the permanent loan side, it really has helped out the ability for sponsors, to increase the amount of financing that they can get on a particular property because of their ability to lock in a very, very attractive interest rate. Happy to talk through where specific rates are for the various loan products, but I think in general, they're very attractive on the permanent loan side, and all in still lower than where they were, 18 months ago.
Great. Thanks for that, John. Danny, how about a little bit on the construction side?
Sure. So on the construction side, we're talking about short-term rates. I think most of the large banks, certainly U.S. Bank, lend against LIBOR. I'll say a little bit more about that in a minute, as long as I've got the microphone, about the switch away from LIBOR. But I'm talking a little bit about where rates are. LIBOR for my entire, really most of my banking career, which is now 15 years, has been very low, below 50 basis points, really since the last financial crisis in 2009. It had just started to sort of peek its head up above that 50 basis point level, which previously would have been considered normal when the pandemic hit. So LIBOR today, 1 month LIBOR, is down to 8 basis points. So that'll give you an idea. It's basically been there since probably the third week of the pandemic, maybe. There was some interruption very early when people didn't know exactly what was going on in the short-term interest rate markets. That settled down very quickly in the spring of 2020. And since then, we've just been in kind of a low rate environment. Spreads, I think, have started to tick up a little bit. I think developers are probably familiar not by now with interest rate floors, which is something that were pretty widespread back during the financial crisis and had kind of gone away until the pandemic, and they're back. They're not very high floors, or at least from the banker's perspective, Don, they're not very high. Somewhere in the 50 basis points. I think earlier in the pandemic, they were up around a full point. So your borrowing costs on construction loan and taxable deal are probably going to be around 3% and somewhere between 2.5 and 2.75 on a tax exempt deal. So historically very good. And as long as I've got the microphone here, got a really exciting topic in LIBOR. You may remember there was kind of a scandal several years ago where the bankers, I was not one of them, but the bankers that reported the transactions that were used to set the London interbank offered rate, which is what LIBOR stands for, we're up to some shenanigans. And since then, regulators have been sort of saying, hey, we're going to make you go stop using LIBOR. Well, that day is actually here. So I know U.S. Bank is trying not to use LIBOR on any deals that close, even starting here in the next 30 days or so. And we are switching to the secured overnight funding rate, which is SOFR. It's very similar to LIBOR. Today's LIBOR rate is 8 basis points. Today's 1 month term SOFR rate is 6 basis points. So I'm probably not qualified to say anything more than that. But just if your banker is telling you they can't use LIBOR anymore, and they're switching to SOFR or to there's a few other rates out there, they're not trying to pull one over on you. This is something it's a real thing. So just want to make sure your listeners are aware of that, Don.
Good. Thank you both. And Dan, thank you for that. That is good data. I know I'd heard a little bit about that. I think I've heard some other people talking about the index. So that's really good for us and all of our listeners to kind of know about the SOFR. I'm sure we'll hear more about that. Just kind of have one last question for John. John, I know, we talked about where we've been, where we are, and maybe switching just a little bit to workforce housing. And I know the Fannies and Freddies are pretty active. Can you just maybe give us a flavor for what's going on, with the GSEs in the workforce housing space?
Yeah, absolutely. Thanks, Don, for that question. That is a major topic right now that I think your listeners should definitely be aware of, especially the listeners that are in the acquisition rehab space. Essentially, what Fannie and Freddie are doing is they are really taking a closer look at naturally occurring affordable housing. As part of their lending requirements, they, in 2020 and into 2021, they're required to do approximately 50% of all of their business in what's considered mission. Typically, the previous scorecards for the GSEs that came out did not really dictate the amount of mission business that they had to do. They looked at it as kind of business that they had to do just naturally versus a requirement to do 50 cents of every dollar, focused on affordable and workforce housing. And the reason I want to mention the workforce housing piece is because they define the workforce housing as up to 80% of AMI. And although workforce housing in some high cost markets across the country can go up to 100, 120% of AMI, I think for most of the country, rents that are naturally at 80% of AMI would be considered workforce, right? They don't quite qualify for some of the subsidy programs, like units that are restricted at 60% AMI or below. But at the end of the day, those tenants are still out there and they're still paying a very large portion of their income towards housing, which is not sustainable, especially in a consumer-based economy like we have across our country. So what we've been doing is really focusing on providing, pricing breaks on transactions that maybe don't have a restriction in place, where either the sponsors either willing to enter into a self-imposed restriction, or the rents are just naturally below 80% AMI. So that's something where even if you're acquiring a property, and let's say there's no rent restriction that's in place, I would still, your listeners should still work with their favorite lender out there to request and see if it qualifies as a workforce housing execution, because that is something where they can get favorable pricing breaks. And we're talking anywhere from, 20 to maybe even 40 basis points as a pricing reduction if a particular property qualifies as workforce housing. Another very interesting program that's out there is Freddie Mac has a forward execution. They call it the non-LIHTC forward program. And this is for essentially any type of a new development that is occurring in which there is a restriction that's in place, but the restrictions are, above 60% AMI. So if you're doing a project where, you want to restrict, 50% of the project at 80% AMI, and it's a new construction project, you have the ability to call up my friend Dan from US Bank and get a construction loan from US Bank, assuming it qualifies for their credit standards. And then you have the opportunity to work with a Freddie Mac to place a forward rate lock on that construction loan, which was not a program that was previously available. And I think it really does help out with predictability on the exit strategy by locking in a forward interest rate on a transaction that does not have tax credits. So that's a couple of different highlights I think the listeners should be aware of in regards to some of the workforce housing programs out there.
Very good. That was, again, just a really good information for people to hear about. Dan and John, really want to thank you both for joining the Buzz House today, and a lot of information, some new information for our listeners, and good to see where we are in the debt markets. And listeners, thank you for tuning in today. Thank you for listening to Buzz House. To receive a notification when new episodes are available, please subscribe to Buzz House, a Baker Tilly podcast, wherever you get your podcasts. For additional resources around multifamily housing, check out bakertilly.com. And if you have a suggested topic, please send them to build@bakertilly.com. That's BUILD@bakertilly.com.